ETF Showdown, Charles Schwab versus Vanguard. Hey everybody, it's Doug the Retirement Guy, and today we're going to be talking about Charles Schwab versus Vanguard. Who really works the best in your retirement fund? It's going to be a surprising answer. Of course, I already know the answer, but it's going to be real surprising for you where it all comes about. Charles Schwab offers some low expense ratios, some strong ETF lineups, some tax efficiency, and is very investor friendly. While Vanguard has that low cost leader, they have a broad market exposure, a passive investment experts, and they're really built for investors. So today we're going to break it all down because a lot of people have asked me when our three bucket system was put out there, where do you put things? How do you put things? Where do I put these funds? Where does a growth fund? What do I use for foundation? So we're going to answer all those today. Before we get into the video, I got to do a shout out to all of our Patreon supporters and all of our YouTube subscribers. Thank you so much. You guys are phenomenal. And the other ones I got to shoot out to you guys. I did not know it would be this big, but the Retirement Made Easy Living Off of Dividends coffee mug. I want to just say thank you for everyone who's bought that. We have gone through, we're already through our second full batch of coffee mugs. We're going to put another order in for another set of coffee mugs again. So if you want a coffee mug, hey, it helps the channel. You don't even have to go to Patreon. You just go down to the bottom description, click the link down there. You'll go to a website who's helping us, and you can get your coffee mug and shipped immediately right out. So you want to help the channel? It's the simplest and the easiest way to do it. Let's get into today's video. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So the four-way matchup overview. Here's what I decided to do. It's two battles in one that we're trying to do. And the one goal is the best retirement ETFs for America's two largest fund houses. So battle number one, we're going to call it, is the income battle. And that's going to be Charles Schwab's SCHD versus Vanguard's VIG, which is their Dividend Appreciation ETF. Now, I will tell you up front, I'll be honest, I have SCHD. I've held it for a while. Thought it was one of the best funds out there. So I wanted to really find out, is this an income from dividend fund? Where do you put it in your portfolio? And then battle two, as we go through, is going to be our growth side. Charles Schwab SCHG versus VUG, the Vanguard Growth ETF versus Charles Schwab's Large Cap Growth ETF. So we're really looking about capital appreciation on our growth, and we're looking for income from our income side. So we really want to see, how does this all fit? So let's take a look at the dividend fund profiles first. Charles Schwab, the U.S. dividend, this is what people have said is the gold standard for income, for dividends across the board. That tracks the Dow Jones U.S. Dividend 100 Index. It holds about 100 different stocks. Expense ratio of 0.06. Pays out quarterly distributions, and their yield really is about 3.25 to 3.28. Now that number, I'm going to say, is just a touch misleading. And I'll answer that question shortly here. Primarily, it's looking for high quality dividend income. It screens for that dividend history, financial strength, and sector balance. They're into the healthcare, the consumer staples, industries, and finances. They're not heavy into the tech anymore. They're really into these kind of categories. When we go up against the Vanguard side of it, the Vanguard Dividend Appreciation ETF, VIG. Now, this one tracks the NASDAQ US Dividend Achievers, the Select Index. There's over 331 stocks that they have. Their expense ratio is virtually nothing, 0.04%. Pays quarterly, but the yield is 1.47 to 1.60. And this one has a broader diversification, a lot of dividend growers, and a lower concentrated risk. Now, they concentrate dividend growth. The companies for the long record of increased dividends year over year. So a really big difference between picking, is the Dow Jones better? Is the NASDAQ better? When we put both of these up on the board, apple for apple, we take a look. Charles Schwab has $95 billion under net assets. When we look at Vanguard, it's 107. So we're about $10 billion difference between those two. The PE ratio, 17.99 versus 24.87. 3 billion shares outstanding of SCHD versus 464 million. So ton more funds out there with Charles Schwab. Now that one pays $1.06 over the past 12 months, which is 3.28%, paying quarterly. Now, here's the big thing I looked at. And I'll give you the dividend here is $3.45 or 1.46. This is what's crazy. That dividend yield, 3% to 1%, you would say go to 3%. The dollars back in your pocket, $1 versus $3, you'd probably say go with the $3 one. Look at the price between the two funds. The 52-week high on Charles Schwab was $32.92, while the 52-week on the Vanguard is $238. That's the difference of 3 billion shares versus 464 million shares. So if Vanguard ever did we'll just call it a split and issued more shares, the price would come dramatically down and we would see a big difference in the share counts and price of the fund. So most average Joe investor can buy Charles Schwab much easier than they can in the Vanguard system. We look at down below the performances. Okay, since inception, and I'll give you this, is Charles Schwab is over almost 15 years old, while Vanguard is 20 years old. So we go to the inception rate, 13.18% total return for Charles Schwab, 10.19% on Vanguard. So I'm giving you some things to say, what's making it better and worse? Well, a better total return from Charles Schwab, a higher dollar dividend from Vanguard, a higher percentage from Charles Schwab. Expense ratios, boy, I'll tell you what, you can throw a dart at either one of those. They're both almost literally free at 0.06 to 0.04. So I really believe that the dividend fund profile, this SCHD and VIG total returns, the winner is going to be Charles Schwab. 25.87% over the past 1 year versus an 18.22% over 1 year from Vanguard. I think Charles Schwab has just done a better job for what we'll call the retail investors, the retirees, while Vanguard is more appreciated in 401ks, in special packages, and buying accordingly. Now let's talk some growth funds. The profile is Charles Schwab's large cap growth versus Vanguard's growth. Now that Charles Schwab tracks the Dow Jones again. Okay, it uses the large cap growth index with about 250 plus large cap U.S. growth stocks, their expense ratio of 0.04, and their heavy tech and innovation exposure. When we look at Vanguard's growth, it tracks the CRSP U.S. large cap growth index. It only has 154 holdings. The expense ratio is 0.03, so again, we're so minute between these two. And it has a slightly higher volatility than what SCHG does. And you can see in the beta between the two, 1.19 to 1.24. Both of them have about the same exact yield. So they're really looking for a capital appreciation and minimal income is between the both. Both funds completed share splits in 2026. So really dial them both into. They both have quarterly distributions, but they're focused on long-term capital growth. When we go up head to head, and this is amazing, this is almost the opposite of what we just seen. $58 billion in Charles Schwab, $222 billion in Vanguard. Again, expense ratio is about the same. 1.75 billion shares versus 3.10 billion shares. Almost double the number of shares. 13-cent dividend versus 33-cent. Again, not designed for income. This is about growth. But Charles Schwab gives you that price around that max out $35 price point to a $90 price point. Even with those splits, it got everything back in line to retail investors can borrow Charles Schwab very, very comfortably, versus Vanguard has made it easier, but not as, it's not the big $600 price tag or $300 price tag. It's down to that $90 price tag. So let's take a look at these. Again, we're looking at 2009 was introduced. So realistically, we're about 15 years into this versus 2004. So they got about 5 years more into it, about 20 years into it. So let's go all the way to long-term inception. 16.12% total return from Charles Schwab to 12.01%. So very, very close to these. If we go the 10-year mark, 18.62 to 17.88. So it looks like Charles Schwab, other than this past year, has won the battle, but Vanguard has won it in the past year. I actually put Vanguard Dividend Appreciation ETF in front of the Charles Schwab. It's primarily because of that total return at 16.86, about 1 percentage more than what Charles Schwab has done. Long term, Charles Schwab maybe has a little more diversification to it. Maybe it's been there. I just like what Vanguard has done with this particular fund. When we look at fees, the VUG, hands down, 0.03. This is what was so crazy and why I kind of chuckle and laugh with this. If you had $10,000 into the fund, it would cost you $6 a year in fees for SCHD, $4 for Vanguard, $4 for the growth fund of Charles Schwab, and $3. If you're in the boat, your fund should make up that $4, $6, $3 across the board. Very, very minimal money. That's why these funds are very attractive in retirement funds. Now for our yield seekers, I told you earlier, these numbers are out there. The bottom two are not designed. They're designed for growth. VIG was designed for income. Charles Schwab was designed for income, 3.25 to 1.53. Again, another reason why I told you that Charles Schwab is the answer to income. So $100,000 invested means you'd get $3,250 versus $1,530. Huge difference between them, almost double. When we look at the income over long periods of time, okay? Now, VIG just basically leads recently. It's been outperforming across the year to date. From 7.87 to 5.54. When we get into the 1 year, it's still winning at 12.89 to 9.48. So we start looking at over the 5 years, though, Charles Schwab wins at 12.67 to 11.65. So a 1% difference range right there. So you got to question yourself and say, well, if they're getting a higher return from Charles Schwab, but now VIG is starting to pull away with it, how does this all work? Well, the biggest problem that people don't understand is how Charles Schwab's fund actually works. Here's the real numbers to be looking at. After 10 years with Charles Schwab, your portfolio, if you put the same amount, that $10,000 into the particular fund, okay, in 10 years, your portfolio would be at $16,289. Same amount for both funds. But look at your annual income. $758 versus $56. Your monthly income would be $63 versus $4.72. Your cost from yield. Charles Schwab continues to grow. And as they continue to grow the fund, that 3% always kind of stays right there as it moves along, but your cost is staying the same as the value goes up. So without reinvesting dividends or anything like that, if you bought 10 years ago and bought Charles Schwab, you would actually have a yield of 7.58%. That's kind of right where I'm at. I always told you guys, when I have my Charles Schwab, it's paying me about 8% per year because I bought it a while ago. I just put money away into it and let it sit. So when the fund starts off at 325, that's a good number, but it will grow in 10 years. Doubles the 3.58%. So these are the kind of things how you compare apples and apples, why I always lean, say Charles Schwab is the better choice. Even though the VIG is starting to pick up some pace lately, Charles Schwab long term is the better buy. When we start looking at growth pairings, now this one is where we go the opposite way, Charles Schwab versus the Vanguard. In 1 year, the VUG is up 30.6%. It's blowing away Charles Schwab. 3 years, same thing. 5 years, 5% difference. 10 years, we're going to lean that over to Charles Schwab because they had a better run by about 2 percentage points. But over the past 5 years annually, VUG has just dominated by basically almost a 10% difference per year. When we look at the annuals of 24, 23, the only time that really hurt was 2022 when they had the bad run, negative 33%. So the VUG wins on recent returns and up to basically about the 5-year mark. So I think they've been able to turn things around. And this is not just a winning by a point or two. We're talking 20 points 1 year out. We're talking 10 points 3 years out. We're talking 5 points 5 years out. So long term, the VUG definitely crushes the Charles Schwab side of it. Now, risk versus volatility metrics. Charles Schwab, the SCHD, low. It's a value-orientated fund. Volatility is very low. Income stability is very high. Drawdown risk very, very low. When we go over to Vanguard, it's a moderate area. They're playing in some different areas with that NASDAQ. It's a moderate volatility. There's more volatility than you're going to see in Charles Schwab. Income stability, we're going to sit here and say it's high. They have a lot of dividend growers. Their risk is moderate. It's a defensive with a growth tilt versus mostly defensive of all 4 categories. On the growth side of it, you got to give it the little beta is over to Charles Schwab. Very, very little for the volatility. Volatility is high. Volatility is the highest with VUG. Income stability is very low because there really is no income. Drawdown risk is higher, but they both have super strong growth sides of it. Amplifies the gains and the losses, and it's a higher upside on Vanguard with its highest downside potential. Retirees need stable cash flow and should weight should go to SCHD or VIG. I believe the growth funds offer no income cushion. That's why I'm always like in income, we're gonna with that Charles Schwab. So guys, here we go, the 3-bucket system. If you don't know what I do here in a 3-bucket system, I actually just did a deep dive into the video as we talked about. I explained bucket number 1, foundation. I blamed bucket number 2, your growth fund, and bucket 3 is your income fund. So where would you use these funds? Why would I be part of the retirement side of it? Well, it's going to be real simple for you and really understanding exactly what funds you put in for what reason. The funds I pick, for me personally, Charles Schwab SCHD is best for income, I call now, and for later. The sooner you get in, the better your chances are down the road of getting to where we're talking about. That yield, 3.25, is roughly 2 times what VIG's payout is. The quarterly cash flow for current living expenses and stronger 5-year total return numbers, Charles Schwab checks off every box that I have when it comes to income side of it. Now, is 3.25 going to pay all your bills? No. Is 3.25 making you excited in your chair to go buy Charles Schwab? Definitely not. And that's for retirees who need income today. But if you're one of our viewers that are sitting out there 5 years away from retirement, 4 years away, 10 years away, the best income later is what happens. 3.25 today, 7.58 yield later. So this is the fund that you put money into and you let it grow. You work with it, you keep putting money into it and let it grow, okay? You're not going to get big money up front. You're going to get big money down as the market continues to grow with the fund, as they continue to make changes. So would I be sitting here saying, hey, 7.58% yield is phenomenal in my income bucket? Most definitely. And that's where this would go, income bucket. Now the growth pairing, Charles Schwab, I put the winner is in Vanguard. Now the expense ratio, again, I'm not going to argue one that 0.03 versus 0.04 is no big deal there. And the beta, the volatility beta is slightly higher, but not enough to make me keep up at night. What I liked about it though is that significantly outperforming, because this fund, you want it to grow, right? And it has a bigger assets of $231 billion out there. I don't really need to worry about it. So your winner comes in with the lowest fees and the strongest recent returns. I just think Vanguard is the strong horse in this race. Now, I got to give a runner-up. It's marginally less in the volatility. It's a broader index. So I can't say anyone's wrong with Charles Schwab. So I'm not going to say a bad fund, win here. Both very, very good. This was a tough one to pull, but I just really put down there. I think that significant outperformance over the past 1 to 3 years, Vanguard's going to win this battle. So building a balanced retirement portfolio, well, conservative. You need income now, but you're also going to need income down the road. Charles Schwab fills that bid the best across the board. Moderate balance approach. I think all these funds have an equal weight across the board. And I really like the equal weight between Charles Schwab and the VIG, okay, for income, and equal weight with the Charles Schwab and the VUG. It's a blend performance of income with appreciation. And the aggressiveness, if you're aggressive, first mindset, I really put it, you can see where I put it, putting more money into the growth side of it than the income side of it. So the real question is, how much income do you really need today, and how much growth do you need for tomorrow? Is where you're at in life. So if you're really trying to be conservative and you want to have a lot of income and you want to start now and build down the road, that's where the conservative comes into. You want to be aggressive and build your portfolio out, you're going to put more money into your growth package. So let me give you a final comparison, the summary table of the ETF winners. If you're looking for the lowest fees overall, well, Vanguard's going to win. And these numbers are so minute, 0.03 to 0.04. Dividend funds, VIG wins with the lowest fee. Now, these fees, I'm telling you, are not going to play much in a game across the board. While we get the growth fees, again, a lot of people focus on fees, but they're all built into the price anyways. Highest yield, Charles Schwab, 3.25 to 1.5. That's today's numbers. What it is down the road is huge, major difference, and I showed you that in the computer report that we did. Recent growth, 1 to 3 years, VUG is definitely going to win this one across the board. Lower volatility, Charles Schwab. Best income for now, Charles Schwab. Best dividend growth, Charles Schwab. And best for long-term growth, VUG. The best pairing of this is Charles Schwab's SCHD and VUG. That puts it all together, that if you put the right person on the bus and then put the right person in the right seat on the bus, you're going to have a great bus ride. So if you put Charles Schwab into the income bucket and VUG into your growth bucket, you're going to be sitting here saying, wow, what a difference in my portfolios 5-10 years down the road. So the bottom line, what should you own? So I really give you, every fund works equally and differently. So you don't have to really choose. Vanguard wins on the fees across the board. Charles Schwab SCHD wins in the yield category, and the best retirement portfolio may not choose between brands. It may own all four. But in my book, Charles Schwab and VUG are the two funds that I've first put into my portfolio. Why? Charles Schwab's going to give you that yield today and yield farther down the road. 3% today, probably closer to 7 or 8% down the road. That's what I've experienced. Now, VUG leads that 1, 3, and 5 year returns, then that's what you need. You need a solid returner going in on a regular basis. And the volatility, you can sleep well at night knowing you got Charles Schwab in your back taking care of your corners. Guys, let me know what you think. My answer, like I said, I picked two, Charles Schwab and VUG, both into my income bucket and my growth bucket, and works beautifully. Let me know what your thoughts. Leave a comment down below. If you like what we did here, love to hear from you. If there's a fund that you think's better than any one of these, put it down below. I'll do some research with it. Also, don't be afraid to hit that like button. And I do got to say one more time out there, thank you to everyone who's bought that coffee mug. It's amazing how you guys done. We're about ready to put our third order in already. I just can't believe this. It's just something that great helps the channel. You can get it for free. You don't even have to get it on Patreon. Just go down below. Thank you, and we'll catch you next time.